Most retirement advice is about what to buy. Max your 401k. Invest in index funds. Start early. That advice is right, but it's only half the equation. Because the other half, the half almost nobody talks about, is what not to buy. Specific purchases that feel intelligent, sound reasonable, and quietly drain the wealth people spent decades building. Welcome to Mindcraft, where ideas become action and action becomes your future. Today we're going through 8 of those purchases. Some you'll recognize. At least 2 will challenge something you've been told is smart. Hit like, subscribe, and share this with someone who's 5 to 15 years from retirement. Let's get into it. 1. Whole life insurance as a retirement vehicle. This one requires a clear distinction up front. Basic life insurance, the kind that pays your family if you die, has a real purpose. For younger adults with a mortgage and bills that couldn't be covered without their income, that coverage is often essential. That's not what this is about. The issue is whole life insurance being sold as a retirement strategy. The pitch sounds intelligent. Your premiums don't just buy coverage, they also build a cash reserve inside the policy, like a savings account that you can draw from later in life. The problem is what that reserve actually earns. Whole life premiums run significantly higher than basic coverage for the same protection, and the growth rate on that internal account consistently trails what a straightforward investment portfolio produces over the same period. A woman in her late 50s once showed her financial advisor a whole life policy she'd been paying into for 20 years. The agent told her it was building wealth. When they ran the numbers, her cash value had grown at roughly 2% annually. Her neighbour, who bought cheap term coverage and invested the difference in index funds, had 3 times as much saved. Keep insurance and investing doing the jobs each was built for, separately. The lesson for everything that follows: complexity has a price, and that price is rarely disclosed up front. 2. Structured products. If the previous item sounded familiar, this one probably doesn't. That's exactly the point. Structured products are contracts sold by banks that combine a basic bond, a loan you give the bank that pays you back with interest, with a financial side bet tied to how the stock market performs. The pitch sounds almost perfect. You participate when markets rise, but you're protected when they fall. What's missing is where the cost lives. Unlike a standard investment where fees are clearly listed, structured products hide their cost inside the contract. No line item, no quarterly bill. The bank builds its profit in before the product ever reaches you. The protection is also rarely as clean as advertised. There are caps on how much you can gain in a strong market, and the downside protection often disappears entirely if markets fall past a certain level, precisely when you need it most. A simple rule wealthy retirees live by: if you cannot explain in one sentence how an investment makes money and who takes the loss when it doesn't, walk away. That confusion is never an accident. It is a design choice. 3. Actively managed funds with high fees. This one has the most consistent data behind it in all of personal finance. An actively managed fund is a pool of investments run by a professional money manager whose job is to pick stocks that will beat the market. You pay them an annual fee for that expertise. The idea sounds reasonable. The results are not. S&P Dow Jones Indices tracks how these managers actually perform every year. Over a 20-year period, roughly 94% of actively managed domestic funds underperformed a simple index fund, one that tracks the overall market and charges almost nothing to do it. The fee gap compounds the damage. The average actively managed fund costs 10 to 20 times more per year than a comparable index fund. On a $500,000 portfolio, that difference can quietly accumulate to hundreds of thousands of dollars over a 20-year retirement. Not from bad bets, just from costs leaving silently every year regardless of performance. A retired teacher once calculated that the fund her broker recommended had cost her, in fees alone, more than $80,000 over 15 years. She never saw a single bill, it just never showed up in her balance. Index funds are boring. That is precisely why wealthy retirees love them. 4. High-fee annuities. Annuities are not inherently bad. A simple fixed annuity, where you hand over a lump sum and receive a predictable monthly payment for life, can make genuine sense for someone who wants certainty. The danger is in the complex versions. Variable and indexed annuities are sold heavily to retirees because they use one of the most powerful words in personal finance: guaranteed. For anyone anxious about outliving their money, that word is almost impossible to ignore. What often gets left out is the total annual cost. These products layer fees on top of fees: management, insurance, administration, and the income guarantee itself. Stack them together, and the total can reach 3 or 4% per year. On a $500,000 account, that is up to $20,000, leaving every year before you earn $1 of return. Most also carry a lock-up period, typically 7 to 10 years, where withdrawing your own money early triggers a large penalty. For a retiree whose health and circumstances can shift quickly, that trapped money is not a safety net. It is a cage. The simpler the income product, the easier it is to evaluate. That simplicity is not a limitation, it is a feature. 5. Timeshares. The timeshare pitch is emotionally constructed to be difficult to refuse. Guaranteed vacations for life. A family tradition. Travel costs locked in forever. Skepticism is framed as pessimism, as if questioning the math means you don't value experiences. The reality is well documented. The American Resort Development Association, the industry's own trade group, openly describes timeshares as use products. Their value comes entirely from using them, not owning them. On the resale market, they routinely lose 50 to 80% of their original purchase price. Many owners have listed theirs for a single dollar just to escape the maintenance fees, which continue whether you visit or not. One couple bought a timeshare the year before they retired. They used it twice. 8 years later, they were still paying $1,200 a year for a week at a resort they no longer wanted to visit. They could not give it away. Wealthy retirees travel on their own terms. They rent what they want, when they want, and keep their money working elsewhere. 6. Collectibles as core retirement assets. Classic cars, fine art, rare wine, vintage watches. These can be genuine pleasures to own. The problem begins when they get counted as part of a retirement plan. In retirement, emergencies don't wait. A medical bill can require cash within days. You cannot sell a vintage watch quickly at a fair price. You need the right buyer, authentication, possibly an auction house, and weeks of patience, while the clock is running on whatever triggered the sale. The market for collectibles shifts with culture and trends in ways that are nearly impossible to predict. Enjoy collecting. If values rise, that is a bonus. But retirement income needs to come from things you can access when life demands it, not things that need a specialist and months to become cash. 7. Vacation homes. The picture is compelling. A lake house, a beach property, weekends with grandchildren, a second life somewhere you love. For many people, this is the emotional centerpiece of what retirement is supposed to look like. The carrying costs are just as real. Property taxes, insurance, maintenance, utilities, and association fees typically run between 1% and 4% of the property's value every year. On a $500,000 property, that is $5,000 to $20,000 annually, before any mortgage, to maintain something you may use 2 or 3 weeks out of 52. The deeper cost is what that capital could otherwise be doing. Invested conservatively, that same money generates around $20,000 in annual income. The vacation home isn't just costing you maintenance fees, it is costing you the income you chose not to collect. Renting exactly when you want it, no off-season fees, no maintenance calls, no empty property in January, is more freedom than ownership. 8. Rental properties that don't cash flow. Real estate has built more generational wealth than almost any other investment. That is true. The problem is when people treat it as a universal truth rather than a conditional one. In retirement, there is only one question that matters for a rental property. Does it put money into your account every month, or does it take money out? Not what it might be worth someday, not the equity on paper. Just, is it paying you right now? A rental that doesn't generate positive income after taxes, insurance, maintenance, and vacancy isn't a passive asset. It is a second job. And unlike a stock you can sell in 60 seconds, getting out of a bad property takes months of negotiation and legal fees, while carrying costs keep running the whole way through. Real estate can belong in a retirement plan, but the standard has to be ruthless. The property works for you, or you don't own it. Every item on this list shares the same architecture: high fees, hidden complexity, or an emotional story designed to make the math feel less important than the feeling. The question that cuts through all of it is one sentence: what is this actually costing me, and what else could this money be doing? Wealthy retirees are not smarter than everyone else. They have simply learned to ask that question before they sign, not years later when the answer is expensive. They chose clarity over sophistication, and boring over complicated. That discipline is available to anyone. The earlier you apply it, the less it costs you. Is there a purchase you've already made, or were about to make, that landed differently after watching this? And which of these 8 surprised you most? Drop both in the comments. If this gave you a clearer framework, hit like, subscribe, and share it with someone who needs to hear this.